From a time when mutual funds had to be explained line by line to investors in Gujarat, to building an asset base of over 1,000 crore rupees at Vikalpa Finvest, Ramkumar Barchha has built a wealth practice that has grown steadily. Today, he speaks to us about building trust before scale and process before products, and why staying boring has often been the most profitable strategy. Thank you so much for joining us today. So let's talk about when you actually began mutual funds in the year 2002, and that at a time in Gujarat where there were lots of businessmen, everyone was making money, the dhanda was there, but when it was coming to other people making money for them, they said, "Ye kya hai? What are mutual funds?" How did you deal with that? How did you break into this?
So honestly, it was a very exciting journey for me when I started this. Today, we confidently say, mutual fund sahi hai. Perhaps that time, mutual fund sahi hai was a question mark.
Yes.
And especially from the place where I come, which is Rajkot, we have a lot of entrepreneurs and small scale industries and MSMEs on the block. And investing in their own business and making money was an established norm. But investing into a portfolio which can deliver the same amount of wealth generation experience over a period of time was something which people did not believe into. I think what other thing came to my rescue was that at that point of time, there was a specific exemption section 88, which permitted 10,000 rupees to be invested into an ELSS scheme, which qualified for an additional deduction. So I used to go on the street and said, "You don't trust mutual funds at this point of time, but you trust me with on my face value and give me 10,000 rupees." And you'll be, in fact, I'm very proud to tell you that that 10,000 rupees over a period of 23 years are still with me.
Oh, wow.
And today, the absolute return
Huh.
is more than 1,000%. And when people see those kind of returns over a period of time, their conviction has gone up drastically.
Absolutely.
And building a practice is something which we always were committed to. And I think the biggest thing which we did was that we never predicted markets, which people try to always, get it right. We never overcommitted returns. Okay. And the third thing was that if trust matters, then please do. When you go to a surgeon, you don't look at his tools.
Yes.
You look at the diagnosis. And I think that is what mattered the most in places like Rajkot.
Absolutely. And I bet all those investors who are listening to you out on the streets today are saying, "Thank God we put our money." So building an asset base of over 1,000 crore rupees over time, of course. And you spoke about trust being that differentiating factor. How did you go on to build it, to convince clients? Was it all in the numbers? And how did you see the behavior of clients change?
So let me be honest with you, investing into a mutual fund is a very boring business. There's not excitement.
But if you want excitement, go to a casino. This is here for boring, making you money.
Right? But then people get that excitement and still people go and gamble there. Right? But when you're investing into a structured product, I think what mattered to us was that we built processes around that framework. We documented your needs, we documented your risk profiles rather. And we did have people at that point of time asking, what is a risk profile, and how much risk averse or risk adaptive I am.
Yeah.
And we had a lot of simple tools, not asking them to write any essays or something, but simple MCQs to figure it out and give them a risk score. And believe me, over the cup of tea, people used to discuss, "Oh, my risk score is only 80, And I think that played a lot of difference in selecting the right product for them. And then, holding their hands through that volatility periods or period of drawdowns, which really helped us to scale up our practice, which was mainly built on processes, not on intuition.
Okay. And, speaking of intuition, you worked through many market cycles, that post-COVID euphoria that we saw, the dot-com bubble, the post-pandemic exuberance, so much of it. What has your experience taught you when it comes to disciplined, boring style of investing that today a textbook cannot teach you?
So if you're talking about risk, I think, then risk in defined in textbook is basically volatility, right? But in markets, risk is nothing but your behavior when you are under stress. So, if the examples which the history has to give us today of 2008 meltdown, subprime crisis, or even 2020 COVID crisis, the asset allocation was perhaps right, but the public at large deserted their belief into the system and acted in a very negative way, and they moved out of the market. Today, if I were to rewind the time, I think all of us would unanimously agree that if that 2020 comes back or 2008 comes back, I would be an investor, not a seller. And that is what makes difference. So risk is an inherent thing with market, but how do you behave in that periods of drawdown and converting perhaps that notional loss into a permanent loss makes the entire risk definition different from an investor to investor. And our job is to manage that risk appetite or that risk behavior, especially at the time of drawdowns.
You know, we've seen over the years how the mutual fund industry has evolved. About almost 30 years ago, at 1 lakh crore to now 85 lakh crores. Tell us a little bit more about the penetration of SIPs, SWPs. How has that evolved over the years in our country?
I think a very crucial work which SEBI has very rightly promoted through their investor awareness campaigns, which they run it on various media platforms, which has especially made SIP a very darling product. And in fact, it has penetrated to that extent that on a lighter note, people at times come and tell us, I don't want to buy a mutual fund, but I want to buy an SIP. So, I think the investor awareness has played a very important role, and especially small ticket size investments in India for a middle class or a lower middle class. I think this is a very excellent tool of wealth creation which has over a period of time delivered. And even if someone has to, if I have to explain someone on a very basic note that, okay, a rule of 15, that 15,000 rupees at 15% for 15 years, that 27 lakhs becomes 1 crore. And I think people like that figure.
Oh yeah, who doesn't?
And if I have to explain compounding to them in a simpler terms, all I have to say is that this 15 years of investments, if I extend it to 30 years, then that 54 lakh does not become 2 or 3 crores, it becomes 10 crores. And that is where the retirement question comes in. That if today a person who is roughly around 40 or 45 years of age, okay, and is able to accumulate a crore, right, and a younger person who is around 25, because in India we do not have a social fabric wherein your pensions are guaranteed by any institution. So I think a 25-year-old who can comfortably save 15,000 rupees for his retirement, and I think 10 crore is not a small amount which one can ignore.
Absolutely not. And when you put it like that, it really makes sense. And yeah.
And that is where SWP comes in then. So I think the biggest challenge is a seamless transition between from an SIP to an SWP. Because people generally talk about investing, but then what is not mentioned is when do you withdraw it? And I think SWP is an excellent answer to that, and rather tax efficient one also.
Absolutely. You know, I was speaking with someone who said that the years that you waste investing when you're younger, it's difficult to make up for that, even if you invest very aggressively at a later stage in your life. Can you emphasize the importance of starting to invest early and why it's important to build up a corpus for your retirement?
So let us understand one thing, that in India, where we come from, okay, the costs are going up, the inflation is eating away into a lot of your revenues. I think the Gen Z or the new generation needs to understand the importance of investment. I think a lot of situations today promote expenses, and what we have learnt in consumption, and what we have learnt in our textbooks is income is nothing but savings minus expenses, right? But nowadays, I think that savings is to be a part of that expense. and then what remains should be consumed. And I think this is the new generation needs to understand, who really uses credit cards and leverages to their benefit. But living in India, I think retirement number, rather, one should know the retirement number.
Absolutely. Today investors have access to different kinds of instruments. There's, of course, your mutual funds, and then there's PMS, AIF, very interesting exotic products, as one would call it. Are you seeing investor interest here? What are you advising people?
So, SEBI has made a very clear mandate that a product for mass is a mutual fund, which is an excellent wealth creation tool. If you have a portfolio with concentration and conviction, I think then PMS comes as a product which one should look at, which has a minimum ticket size of 50 lakh rupees. And then you have AIFs, alternate investment funds, which has a ticket size of 1 crore. And in fact, now there is a blended version of between the both, which is called an SIF, which starts with 10 lakh rupees. So yes, there is definitely a traction for these products, especially in the upper middle class and the ultra high net worth individuals, who I think has a lot of snob value attached to. I'm also into AIFs and PMS, not only into mutual funds. I think one should need to understand that what kind of products is suitable to you. And if you are, and you should also understand the taxation impact of PMSs and AIFs. And I think returns, when compared, should be post-tax returns, which would give them the real picture. And if you are able to justify the portfolio in your investment scenario, that if this product, for example, an AIF, if it is able to give you that distinction which your regular portfolio is unable to give, and plus it also justifies the illiquidity, because an AIF is predominantly around 7 years or 9 years of investment commitment, then you should go for it. Otherwise, I think you should ignore the noise then.
And you've constantly emphasized that asset allocation is much more important than choosing the best performing fund. What are some of the myths you want to dispel about asset allocation, and why do you say this is important?
So, see, asset allocation is a very beautiful thing when we talked about it. It's like losing weight, all people give an advice, but it's very difficult to follow it, right? So, similarly, what does an asset allocation, if you have to put it in theory, does? That you are supposed to sell what is performing well, you are supposed to buy which are laggards, okay, and you should stick to mediocrity rather than exclusiveness. Now, doing that on a portfolio is very difficult, but it is essential. And I think that is where the role of a mutual fund distributor or an advisor comes to your rescue. And one should spend time and take proper guidance, because these are financial decisions, and course correction is a very expensive proposition in such cases.
Absolutely. Course correction is very difficult. So it's important that you have that right asset allocation at the start. But while equity is celebrated for wealth creation, debt as an instrument tends to be put in the little boring criteria. In a very volatile and an uncertain market, what is your assessment on debt and equity?
See, I think the risk profile plays a very major role before taking an allocation into. But yes, every portfolio should have a debt allocation strategically. Now, debt allows you that freedom which equity does not. Now, it's a very bold statement to make, because debt allows you to rebalance, rethink, and reallocate, especially when you want those assets to be bought at those prices which are very compelling. Now, I think at that point of time, debt does play a very important role. It's like even cash also, even a cash call would be a very important tool when there are emergencies in families and all, which one should provide for. Because sometimes you end up selling a right asset at a wrong price, which really hurts you in your wealth creation journey. So I think debt and cash should be a very active part of your portfolio.
Debt and cash. And, I want to touch upon what you were talking about, because a lot of investors say, okay, fine, SIP sahi hai, I've started it. But if you're going to constantly check those returns and say, Abhi, last month barely anything, the needle has barely moved, and you were talking about the importance of sticking to mediocrity, that you just need to be consistent, you need to be disciplined, and you need to let time play out and have patience. Why is that important? And what messaging do you want to send out to an investor who's constantly saying, oh, I'd rather go for, I have that FOMO, I'd rather go for gold, oh, it went up really smartly, I would rather put my money there?
So I think that's typically a herd mentality.
Yeah.
And most of the investors do commit that mistake. But I think the role of a distributor is just to manage the emotional quotient at that right point of time.
Yeah.
And I think before venturing out into an SIP, I'm sure your distributor would have explained to you the inherent risk. And in fact, there are a series of lull periods in markets where even a 4-year or a 5-year SIP perhaps does not even give you a positive return or does not even beat a savings bank account return. But I think, let me answer this in a different way. If today if I go and ask how much gold do you have, he would make a remark, I have 100 grams of gold. But if I say how much of mutual funds do you have, he would say I have 10 lakh rupees. I think that is the time of unit accumulation. And at that point, I think units needs to be talked about rather than the amounts. And in that lull period, when you accumulate units at a lower price, that is when you get that kicker return when the markets even go back to that mean reversal.
Okay. Yes, absolutely. Apart from that herd mentality, recency bias is another thing that investors tend to fall prey to. What are some of the other classic mistakes that you see investors making, and what should they stop doing now?
First of all, I think day in, day out, people read a lot about markets. I think you should understand that if we are a patient and when we go to a best of the hospital, we trust the doctor, the surgeon, and the medicines which they prescribe. And we don't go, and the doctor tells you that if you have got a broken bone, it's going to take at least 8 weeks to 12 weeks before it mends. And I think that duration you should know before you venture into any particular product. And I think especially the mistakes which people do is that they don't understand the liquidity need which they ought to keep aside for. And you'll always say that, oh, I have enough savings, no, I'll sell it and meet my need. And I think that is where people make a lot of mistakes. They really need to document. This is a very serious exercise and it's not easy to earn money. Right? Yes. And you have to stay committed and disciplined in this entire journey. Only then wealth rewards what is patience,
Yeah. Wealth rewards patience. I think you really gave us the headline. And gold and cash allocations also, they're frequently questioned during a very strong equity rally. Should investors have a decent exposure? Why are they sidelining some of these asset classes?
So historically, if you see, equities have always outperformed gold. So gold is an excellent investment tool at the time of panic. And that is where the gold prices are rewarded. And in fact, this is the right scenario where we see gold appreciating, where central banks are allocating a lot of money. I think gold needs to be a part of anyone's portfolio to an extent of 10 to 15%, because it is a store of value. I think we should also understand that gold does not give you dividend or any regular form of an income, which perhaps a share would give you dividend, or a residential property would give you rent, a fixed deposit would give you interest. So I think gold is a store of value. Okay. And at uncertain times, you do feel cushioned, about the whole thing. It's like putting a shock absorber. The cash and gold are like shock absorbers,
Shock absorber, yeah.
And just because the road is smooth, you doesn't mean that you remove the shock absorber.
Yeah, you need that hedge, you need that insurance.
Yeah, very much.
So now your AUM has grown over the years. How has your role changed from an advisor to a business builder to a mentor? And tell us about which transition has really seen you grow the most.
So I think trust compounds slow than the returns in the market. Okay, but it definitely compounds more than what returns do. over a longer period of time. So I think in popularly in our area, they call it dial R. R is for Ram. And it's like, why don't we take his input before we venture out into any major financial decision? And people then do open up, they do discuss their, which one should rather, they discuss their apprehensions. And in fact, when you read about a lot of products also, you do come and discuss. Whether you invest or not is a different story. But I think knowing about those products and whether it is suitable for me at this point of time in life makes it a very rewarding decisions for them. And what also we see, every wealth which you accumulate has to be seamlessly transferred to the people for whom you have accumulated.
Absolutely.
And I think in India, people have a taboo that, okay, estate planning could be only be done after once I'm old, you know.
Yeah.
And looking at the stress levels, sometimes people don't get old. And it's a very unfortunate thing. And that is the time where estate planning and all plays a very major role. And we have over a period of time developed a practice not only of wealth creation, but I think of wealth preservation also. And seamlessly transferring it to the loved ones for which you have accumulated that wealth. And I think that child dream of going to the best of the schools and the best of the homes needs to be ring fenced.
Yes.
And that's a duty of every person to do that. And that is where perhaps we play a very important role in guiding those people.
So, after 2 decades in the business, which are the principles that really keep you anchored? You spoke about trust before scale, you spoke about wealth preservation. For an investor who's just starting out, what is the messaging you want to give, and where do you see Vikalpa Finvest over the next decade?
So I think the biggest risk which we run even today is a reputation risk. Because once you lose the trust, I think there is no curve which gets you back, or there is no road which says that okay, now the trust is back to the square one again. I think that is the integrity and the trust which we need to preserve for a longer period of time. And we see ourselves the same old boring people who believes in processes, not in intuition, who believes in the framework which we have designed. Okay, and the outcome is definitely positive and certain. And that experience which we try to give to our investors, I think that makes us more relevant in this business even today.
It absolutely does. And that is why you have managed to build a corpus like you have. That is why you have the trust of so many investors who have put their hard-earned money with you at Vikalpa Finvest. So thank you so much for joining us in this conversation.
Thank you.
So as we've understood, markets will evolve. We will see products multiply. But trust, once broken, rarely compounds again. After 2 decades of steady growth, Ramkumar Barchha's journey is a reminder that in wealth management, consistency often outperforms charisma, and patience remains one of the most underrated assets of all. Thank you so much for watching. We'll catch you next time.